In this video, we'll assess the macroeconomic state of a country to assess whether its stock market presents a good investment opportunity. I'm Ramin, a financial YouTuber from the PensionCraft channel, and today I'm collaborating with Trading 212 to teach you more about investment. Remember, as always, that nothing in this video is financial advice, and you should always do your own research. What macroeconomic factors should investors be aware of? We can begin with the three most fundamental macroeconomic measures. These are the ones that people are most familiar with from news headlines. These are gross domestic product, or GDP. This is the total amount of goods and services produced by a country. If inflation-adjusted GDP, or real GDP, falls on a year-on-year basis, this is classified as a recession, which, if deep, usually goes hand in hand with falling stock prices. Inflation is the rate at which prices are changing, and if this is too high or negative, this is usually a toxic environment for stocks. And when interest rates are rising sharply, this usually negatively impacts stock prices, particularly growth-oriented stocks. Although these are the broad principles, the story for each variable is more complex, as we'll see for GDP growth. There are a couple of problems with GDP as an indicator for investors. Firstly, stocks are forward-looking, pricing in information about the future, whereas GDP is a backward-looking measure. This is why the actual relationship between GDP growth and future stock price changes is a weak one. So instead of using GDP directly, some investors use indicators that lead or predict future changes in GDP. And these indicators can signal turning points in the economy. For example, after an economic slump, we might look at indicators such as consumer sentiment surveys, whether businesses are seeing a pickup in new orders, whether house builders are applying for new permits for new builds, whether manufacturers are extending employee hours to service demand, or alternatively business surveys like purchasing managers indices. The PMI indices, for example, in 2009 were a good indicator as they bottomed out just as the markets did. Inflation is another measure that becomes important when it surges either into positive or negative territory. The rate of inflation is the annual change in the cost of living. Stocks usually beat inflation over the long run, but they have a kind of sweet spot when inflation is around 2 to 3%. If inflation is very high, however, then stock prices fall, or derate as it's called. And valuations at this point are falling because margins are being eaten away by higher input costs for companies. Similarly, stocks derate when prices fall on a year-on-year basis, or a state of deflation as this is called. That's because this usually signals a severe problem with the economy as prices are falling because of a lack of demand. And of course that lack of demand is going to hurt the bottom line for companies as there's less demand for their goods and services. Interest rates are another important driver of stock returns. The intuitive understanding of why the interest rate on low-risk investments like government bonds affects the returns on stocks is all about the amount of risk you take in order to generate a return. For example, let's say that the interest rate on short-term government bonds are near zero. That tends to push investors to invest in higher-risk stocks because the low-risk investment is generating such little return. Conversely, when short-term yields are high, that means that investors can earn a better rate of return for low-risk investments. And that higher return comes with almost no risk. This makes much more volatile and risky stocks less attractive. So generally speaking, low interest rates favour stocks, whereas high interest rates tend to favour government bonds. Here, though, we have to consider why interest rates are rising or falling. For example, if interest rates are rising because the central bank is raising rates after the economy's gone through a crisis, then this is a state in which the economy is healing, and this is generally good for stocks. If rates are rising as inflation's surging and the central bank's fighting inflation, as happened in 2022, then this is usually bad for stocks. And this was the case in 2022 during the tech wreck, when the central bank raised interest rates sharply and US tech stocks sold off. Another important aspect of borrowing costs is lending conditions, as these often affect stock returns. Banks are careful when they make loans, but sometimes they're more cautious. For example, they might become more cautious if they think economic conditions are about to get worse. When that happens, they tighten the criteria for approving a loan, and they might make that cost of borrowing higher also. And the reason for that is to cover any future losses. We call this tighter credit conditions, and usually this tends to be a bad environment for stocks. In contrast, easing credit conditions would tend to be a positive environment for stocks. In the US, it's easy to monitor credit conditions using the SLOOS survey, or the Senior Loan Officers Survey. In this graph, red indicates tighter credit conditions and blue indicates looser credit conditions. In the UK, the equivalent survey is called the Credit Conditions Survey, and it's published by the Bank of England. This looks at the supply and demand of loans, as well as the pricing of those loans, and of course the default rates on loans. Most central banks also publish a financial stability report that will give you a warning about tightening credit conditions, or alternatively a pickup in bad loans that could be an indicator of worsening credit conditions ahead and worsening economic conditions. But also a pickup in bad loans, which could be a predictor of worsening economic conditions to come. A more timely measure of credit conditions is to look at credit spreads. When these widen, it's often an indicator of tighter credit conditions, and this is usually a difficult time for stocks. These spreads are freely available in the United States from FRED. That stands for Federal Reserve Economic Data, and it's produced by the St. Louis Fed. So these are just some of the macroeconomic indicators that can affect the investments in a given country. As is always the case, no single indicator gives a perfect picture of which countries offer the best opportunities. However, by monitoring the indicators that we've shown here, you'll get a good idea of which countries do offer those opportunities. But you'll also get an idea of the potential problems that could be brewing, so you could avoid a crisis. Please do like this video, and don't forget to subscribe to Trading 212's channel so you don't miss out on any future videos like this one.